Have you ever wondered whether you're paying more tax than necessary in retirement? A few months ago, I spoke with a retired postal worker from Ohio. Let's call her Barbara. She was 67 years old, living on Social Security and a pension after nearly 3 decades of work. Every year, she handed her documents to the same tax preparer, paid her bill, and moved on. Last year, Barbara owed nearly $900 in federal taxes. The surprising part? Several tax provisions designed specifically for retirees were never applied to her return. She didn't make a mistake. She wasn't trying to avoid taxes. She simply didn't know these provisions existed. And she's not alone. Millions of retirees may be overlooking deductions, credits, and tax-saving opportunities that could legally reduce their tax burden. In today's video, I'll walk you through 5 retirement tax provisions every retiree should know before filing a return. And make sure you stay until the end, because the 5th one is one of the most overlooked provisions in the entire tax code. Before we begin, this video is for educational purposes only and is not tax, legal, or financial advice. Always consult a qualified tax professional regarding your specific situation. Let's get started. Many retirees don't realize that turning 65 can increase the standard deduction available to them. For the 2026 tax year, eligible taxpayers age 65 and older may qualify for an additional standard deduction amount beyond the regular standard deduction. For married couples where both spouses qualify, that additional deduction can be even larger. Here's why this matters. Every dollar added to your deduction reduces the amount of income subject to federal tax. I've seen situations where retirees assumed everything was calculated correctly, only to discover years later that a simple eligibility box had never been marked correctly. That's why it's worth reviewing your return personally, even if a professional prepares it. And there's another important detail. Taxpayers who are legally blind may also qualify for an additional increase. These provisions can work together, creating a larger deduction than many people expect. The lesson? Never assume every eligibility box was completed correctly. Verify it. Now let's talk about one of the newest retirement-related tax provisions. Beginning with recent tax law changes, many taxpayers age 65 and older may qualify for an additional deduction, commonly referred to as the senior bonus deduction. What makes this provision particularly valuable is that it may be available regardless of whether you take the standard deduction or itemize. That's important because most retirees use the standard deduction. For eligible taxpayers, this deduction can significantly reduce taxable income. For married couples where both spouses qualify, the potential benefit can be even larger. I recently reviewed a retirement income scenario involving a married couple whose income came primarily from Social Security and pension benefits. After accounting for their available deductions, their taxable income was dramatically reduced compared with what they originally expected. That's why understanding new tax law changes is so important. Many retirees continue using the same filing habits year after year without realizing the rules have changed. If you're over 65, make sure this deduction is being reviewed when your return is prepared. This next strategy is one of my favorites because it can help charitable retirees while potentially reducing taxable income. If you're age 70 and a half or older and have a traditional IRA, you may be able to make a qualified charitable distribution, commonly called a QCD. Instead of withdrawing money from your IRA and then donating it, the funds are sent directly from the IRA custodian to a qualified charity. Why does that matter? Because the distribution may be excluded from taxable income. That can create benefits beyond simply reducing taxes. Lower taxable income can sometimes help retirees avoid crossing thresholds that affect other areas of retirement planning. Here's a simple example. Imagine a retiree who normally donates to their church every year. If they withdraw IRA funds first and then donate, the withdrawal may still be included in income. But if the funds go directly from the IRA to the charity through a QCD, the tax treatment may be more favorable. The key is timing. The transfer generally must be completed properly and directly through the IRA custodian. Always verify the current rules with your financial institution and tax advisor before proceeding. Many retirees assume they cannot benefit from itemizing deductions. In reality, medical expenses are one of the biggest reasons some retirees still choose to itemize. Here's why. Medical costs often rise during retirement. Premiums, prescriptions, dental procedures, hearing aids, vision care, and certain insurance costs can add up quickly. When eligible medical expenses exceed the applicable IRS threshold, Part of those expenses may become deductible if you itemize. I once spoke with a retired couple who believed itemizing was no longer worthwhile. After adding together their healthcare costs, they discovered their medical expenses were much higher than expected. The result? Itemizing became a serious consideration. The important takeaway is simple. Don't assume. Run the numbers both ways every year. Tax rules change, income changes, medical costs change. The best option one year may not be the best option the next. This may be the most overlooked item on today's list. Unlike a deduction, a tax credit directly reduces the amount of tax owed. For eligible taxpayers, that's incredibly valuable. The credit for the elderly or disabled has been part of the tax code for many years, yet many retirees have never heard of it. Eligibility depends on several factors, including age, income, filing status, and other requirements. Because the income limits are relatively modest, this credit is often most relevant for retirees with lower incomes. I've seen retirees focus entirely on deductions while completely overlooking credits. That's a mistake. Deductions reduce taxable income. Credits can reduce tax liability directly. If your income falls within the qualifying range, it's worth asking whether this credit should be reviewed as part of your return preparation. Sometimes, a single overlooked credit can make a meaningful difference. Putting it all together. Let's go back to Barbara. Once her return was reviewed carefully, several retirement-related tax provisions were identified and evaluated. The outcome was very different from what she originally expected. And that's really the point of today's video. Most retirees don't need complicated tax strategies. They need awareness. The biggest difference between retirees who keep more of their money and retirees who miss opportunities often comes down to one thing: knowing what questions to ask. Before filing your next return, consider these 5 steps. First, review whether all age-related deduction eligibility has been properly reflected on your return. Second, verify whether any new senior-related deductions apply to your situation. Third, if you donate to charity and have a traditional IRA, ask whether a qualified charitable distribution makes sense. Fourth, total your medical expenses and compare itemizing versus taking the standard deduction. And fifth, determine whether any tax credits for older taxpayers should be reviewed. A few minutes of review today could potentially save a great deal of frustration later. If you found this breakdown helpful, subscribe to Decoding Finance and turn on notifications so you never miss an update on retirement taxes, Social Security, investing, and financial planning. And tell me in the comments, which of these 5 tax provisions did you already know about, and which one surprised you the most? Thanks for watching, and I'll see you in the next video.